presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak YouTube update for July the 25th, 2023. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. You can get all of the media that we put out on a daily basis. You can get the daily broadcast, you can get the podcast, you can download the video, you can download the app from the iTunes store, you can get the YouTube updates, that's ones that I do all the time, or you can also get the weekly newsletter. All of that at compak.com. Go down, right down to compak.com. And you can get all of this media. All of it is free. Let's talk a little bit about what we're going to have this week. The biggest thing is going to be the Fed. What is the Fed going to do tomorrow? That's the question. 99% probability that they're going to raise by 25 basis points. Well, what does 25 basis points do? That's already built into the market. So that's a non-event. What happens, what the Fed says, what Mr. Jerome Powell says after the meeting where he does the press conference, then from that, the market is going to try and decipher what is the Fed going to do next. Are they going to continue to raise rates, or are they done? I don't think the Fed will give us a clear-cut answer tomorrow, and that will cause some anxiety in the market. Could give us the excuse for the pullback that I've been talking about, that we should get somewhere. But the markets have a way of surprising most of the people most of the time. They'll go up a lot more than people think they should go up, and the same thing on the downside. So what Mr. Powell says tomorrow, expectation is that he'll say, well, we are going to wait and see for data. If inflation is still going up, then we're going to raise rates. If inflation is not, then we could be, then we'll wait and see. He's not going to say we're done if inflation is coming down, because I still think they want the unemployment to go up. They're not going to say that, but that's what they want to see, is a little bit more loosening of the labor market. That means unemployment going up. They want to, but the problem is when they start having unemployment go up, it usually goes up a lot more than everybody expects. This is what we've seen. Stock market rising ahead of a recession is very uncommon. You can see that most of the recessions is 73, 1980, 81, 90, and so on. All of the recessions you can see is the stock market is usually coming down, not going up. But here we are seeing the stock market go up this year. So the recession chances, which everybody had talked about for the last year and a half, and I said the same thing, no recession until we get unemployment going up. A year and a half later, most of the people are coming to the same conclusion. Oh, well, we might not get that recession. I think we see a slowdown in the second half of this year, but I don't see a dramatic going off the cliff. There's still too much money in the system. Real estate, there's no structural problems. Real estate prices, the Case-Shiller came out today and showed prices are going up. We've also seen that average returns following the last Fed hike. You can see that this is a 60-40 portfolio. You can see that it goes up nicely. This is 12 months later, and you can see here it is the all-stock portfolio. It's up about 15-16% on average once the Fed stops raising interest rates. They've not done that yet. They're going to do that tomorrow. Hopefully that's the last interest rate increase. We'll have to wait and see. So this is, if you're sitting in cash, feels good, but you can see that the market outperforms way, way better than cash. And once the economy, they stop raising rates, the cash rates come down very quickly. All of a sudden, people sitting in cash think, well, wait a minute, I was getting 4 or 5%, now I'm getting 2. Maybe I'll put the money back into the market somewhere. Looking at the economy, unemployment usually rises after the start of a recession, not the beginning. Once the recession starts, that's when we see unemployment going up. That's what we've seen, not before the recession. So unemployment is really a lagging indicator, not a leading indicator. Unemployment going up means the economy is already rolled over. Because again, as you've heard me say on the daily broadcast, on the radio, companies are still people. And the last thing people want to do is lay off people. They try everything else before they start laying off people. So I think we are going to continue to see once the unemployment starts to go up, the recession might come or the slowdown. I will talk about all of this in a lot more detail on August the 8th. You can come to the free webinar simply by going to compak.com and seminars and register. It's a Zoom meeting. You have to have an access code, but you can be at home and you can ask all the questions and I will be more than happy to answer them for you. Technicals, resistance still at the 46.37 high that we made last March of 2022. Right now we're somewhere around 45.65. We got up to 45.80 today and then backed off from there. I did this chart just a little bit before the close. If we can, everybody in the world is looking for a pullback. And as I've said earlier, markets have a way of making a fool out of most of the people most of the time. Will the market go straight up, get above 46.37 and go to the Fibonacci? This is the Fibonacci projection from this March high, and it comes in at 48.08 to 49.23. Remember, the all-time high is 48.18. So will we go straight up? I don't think so. I think we get a pullback before that, but you never know. You can't be waiting and betting on the pullbacks or the bear market. Weekly chart again, each one of these are weekly. This is a 46.37, the March 22 high, and then the all-time high at the beginning of last year, which is 48.18. That's the number. And that's on the daily charts is also the Fibonacci target. If we get above that, then we're looking at this projection projects forward. This is a weekly chart, so it could be long-term, a year and a half from now, 5,000 to 51.50. Are we going to get there? Well, first we got to get about 46.37, 48.18, then we start looking at those numbers. Nasdaq, same thing. All of these are fifth wave highs. Once we see wave 5, markets have a way of turning back down. Support now is still at the 20-day moving average, 13,932. Then we've got the 50-day moving average, 13,416. We are at about 14,000 today, plus or minus on the close. So we are stretched. But that does not mean the market has to come back. It should, but market doesn't have to do anything. Market does whatever it wants to, whenever it wants to. The trick is to get ourselves out of the way. Looking at the weekly charts again, 14,650. That's the March high of last year. Then the all-time high that we're looking at right here is 15.8. So that would be the next resistance area. I haven't done a projection from this Fibonacci to up here, but I should be up here somewhere around 16 or 17,000. We'll have to wait. I'll do that at the next YouTube update. 10-year note bouncing around. This is 409. This is the high that we made last year. This is the high that we made right here. This is the high we made in March. We come back down. We're at 3.91 now. Just bouncing around within this channel, going back and forth. And until we get a clear indication of what the Fed's going to do, I think we continue to do this up and down in the market. Gold market clinging on to the 50-day moving average, which is right around 1960, closed around 66 today. Again, tomorrow if the Fed comes in and says, look, we're going to continue to raise rates, gold comes down hard, breaks below 47, which is the 20-day moving average, and head towards the 200-day, which I think eventually, because this is wave 1 to the downside, 2 up, 3 down, 4 up, and we get the 5th wave to the downside usually. That's the way Elliott wave works, so I'm waiting for that pullback. Those are my views. Those are my thoughts. Again, if you'd like to get more information, what we do, how we do it, come to compak.com. I will do the webinar on the 8th. Register for that. Or if you want to just come by the office, make an appointment at compak.com. Thank you again for joining me today.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.